Hello everyone, I am Zijing Wu and this is Group 5. Our group members are Shaiqi Lou, Lu Tang, Shuo Tian, Ying Chen, and me. We are excited to present about income tax for Australian business. So, firstly, I will discuss about the difference between accounting profit and taxable profit. Before beginning, we need to figure out the definition of accounting profit and taxable profit. Accounting profit reflects business financial performance according to accounting standards. It equals to net income or total revenue minus expense. The cost can be considered as labor expense, inventory, raw material cost, and sales and marketing cost. However, it does not include opportunity cost. And taxable income depends on account income and deduction allowable, which equals to assessable income minus deduction. The profit is determined under Australian tax law for business operating. So the business is required to pay tax after tax specific rules, which means the profit after tax is different from accounting profit. So many expenses are not deducted as a taxable profit, such as goodwill, entertainment, fines, and penalty. At the same time, it also has hysteresis. So accounting profit recognize income or expense when it occurs, while taxable profit only recognize once it has already been paid. So it would be different in a given period. It has an impact on calculating depreciation. The difference between accounting profit and taxable profit is because of difference in perspective. Accounting profit is to provide financial performance for stakeholders, while taxable profit is to calculate the tax payable to ATO in actual business running. Okay. Now the next presenter will discuss about the second questions. Thank you.
Yeah, hello, this is the question 2, and my answer is that income tax expense and income tax payment is differently different. So that there are 4 points of difference as I should like this one. So for the definition, the income tax expense refers to the total amount of income tax charges to the income statement for a specific accounting period, including the tax based on the current taxable income and any deferred tax expenses or benefits. So, and for income tax payable, it's represent that the actual amount of the tax owed to the tax authorities like ATO as the financial statement date, usually referring the tax that need to be paid soon and should be shown as a current liability in the balance sheet. And for like the difference calculation basis, and the first one, income tax expense, that is calculated based on the accounting statement. And for the second, income tax payable, it is directly calculated based on the tax law. And they're going to have a temporary differences, and I will be shown later in the exam. And the fourth, it will show in different financial statements. So basically, the income tax expense will appear in the income statement, while the income tax payable will appear on the balance sheet as either a short-term or long-term liability. So I also find an exam in the YouTube, so you can see that this is basically you as a landlord and your tenant is going to pay you rent. It is about $3 per month, and due to the accurate basis, he actually paid you like 30 times. So for actual payment, it will be 39,000. It will be calculated for the taxable income, but due to the accurate basis, so it will be count for 12 times in the account statement. So it's going to be like 36,000. So it will have the temporary difference due to these two results. As you can see that the final result for the income tax expense is 5,600, and for the income tax payable is like 6,500. So that's my answer. These two things is totally different.
Now I will be focusing on a crucial part of our discussion. While a profitable company may have no income tax payable, specifically I will dive into the concept of deferred tax assets (DTA) and deferred tax liabilities (DTL), which are central to understanding this scenario. Deferred tax represent differences in timing between how income and expenses are recognized for accounting and tax purposes. DTA are future tax benefits. These arise when certain expenses are deductible in future tax periods or due to past losses that can offset future taxable income. For instance, if a company incurs a significant loss in 1 year, it can carry this loss forward to reduce future taxable profits. DTL represent taxes that will be payable in the future. This happens due to temporary timing differences between accounting and tax reporting. A common example is accelerated depreciation used for tax purposes, which reduces current tax liability but results in higher future tax payments. Let's take a closer look at practical examples. So for deferred tax asset example, suppose a company experiences a $500,000 loss in a previous year. This loss can be carried forward and used to offset profits in future years, effectively reducing taxable income and lower the tax burden for that year. For deferred tax liability, imagine a company using an accelerated depreciation method for its equipment, which results in lower taxable income today. However, since the depreciation benefits are front-loaded, it creates a deferred tax liability, means tax will need to be paid in future periods when depreciation deductions are reduced. Now let's explore how deferred taxes impact tax payable. When a company carries forward previous losses or has deductible expenses, it can lower current taxable income, resulting in less tax being paid today. This immediate relief helps in managing cash flows and reducing tax liabilities in a profitable year. Conversely, deferred tax liabilities means that while taxes may be lower now due to deductions like accelerated depreciation, they must eventually be paid in future periods. This postponement allows a company to use its resources to grow now, with the expectations of paying higher taxes later. So let's bring to key takeaways. DTA reduced the company's current taxable income, and while DTL postponed tax obligations of future periods. Together, these explain why a company that appears profitable might not have immediate tax payable. Future liabilities and use of past losses can eliminate the need to pay taxes in the current period.
Thanks for the presentation of my partners. Welcome to my part. In this part, I'm going to discuss whether incurring a loss for tax purposes would result in the recognition of a tax-related asset in the financial statements and the reasons. A firm may nevertheless display a deferred tax asset (DTA) while experiencing a tax loss. If lost You may retrieve your asset. If unclaimed, you may establish your entitlement and reconcile temporary disparities. A DTA gives insight into future tax benefits per IAS 12's income taxes. A DTA should be recorded if there is a reasonable expectation of future taxable advantages that might counterbalance non-taxable differences in the near term. IAS 12, December 24th. The reasons can be identified as follows. The recognition of DTAs is guided by the probable criterion, which requires the companies to provide convincing evidence that sufficient taxable profit will arise in future periods. The factors include expected alterations, past performance, and forecasts of corporate profitability. Berman and Das, 2004, contend that the deferred tax assets are a dependable indicator of impending tax escalations. Its value is dependent on management's projections of future taxable income. Moreover, subsequent research by G and Dobler in 2023 revealed that both authorities and assessors place significant importance on DTA identification. This specifically relates to businesses in potentially dangerous sectors. Transparent and accurate financial reporting must adhere to the stipulations of IAS 12. In addition, the challenges associated with recognizing DTAs have been highlighted in various studies. Disparities in DTA recognition may be explained as per a 2001 research by Berman and Horsey by differing managerial viewpoints and exogenous factors like economic changes. Robust and realistic profit estimates, together with accurate financial reporting, are essential for DTA accreditation for term as well. In summary, a business may only recognize a deferred tax asset from a tax loss if it expects future taxable revenue. To consistently implement accounting rules, one must establish reasonable assumptions and provide trustworthy proof. So much for my part. Thanks for your attention, and let's welcome my partner in part 5.
When tax rates change, businesses, individuals, and governments must adapt promptly to ensure compliance and minimize disruptions. Here is a concise guide to the necessary steps. The first step is fully comprehend the changes, whether the invoice increases, decreases, or adjustments. This requires reviewing official announcements and guidelines issued by tax authorities. Businesses should promptly update accounting softwares, payroll systems, and tax to reflect the new rates. Accurate systems help prevent errors in invoicing, payroll deductions, and tax filings, ensuring that tax compliance is met and that financial statements are accurate. Employees, customers, and suppliers must be informed of the impact of these changes. For instance, higher tax rates might increase product prices or reduce disposable income, which can affect demand and cash flow. Tax changes may affect contractual obligations, especially those involving gross or net payment terms. Renegotiating contracts might be necessary to align with the new rates. Consulting with tax professionals is highly recommended to ensure compliance and gain strategic advice and minimizing tax burdens. This professional can clarify in the new regulations and offer advice based on the specific substance of the business or individual. Additionally, adjusting financial plans helps anticipate the broader economic impact, particularly when higher taxes might reduce spending or require operational adjustment, such as cost-cutting measures or business model modifications. Moreover, businesses should prepare for potential adopted risks. Tax rate changes can trigger inquiries from tax authorities, and maintaining accurate, well-documented records of all transactions and communications will help ensure the transparency. For business operating internationally, fluctuating foreign tax rates can complicate cross-border transactions, necessitating careful attention to how changes impact global operations. Governments may offer relief measures or credits that can mitigate the immediate impact of higher tax rates. These measures should be monitored closely, as they can provide temporary financial relief. Proactively addressing these steps ensures a smooth transition, legal compliance, and financial stability, ultimately reducing stress for all shareholders involved. This is our presentation. Now this is the references. Thank you so much.